Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on there? It's January 24th. My friend Curzio, the Wall Street Unplugged podcast. So breaking the headlines and tell you what's really moving these markets. On today's show, I'm covering Netflix blowout earnings. Congratulations to Wall Street Unplugged premium members. Just recommended that stock 5 trading days ago in Dollar Stock Club. That's a trading newsletter Wall Street Unplugged premium members get for free. But I'll tell you why Netflix, even after this big move today, has more upside potential than any of the Magnificent 7 stocks. By the way, Netflix is not in the Magnificent 7. I don't know if everybody knew that. Also talk about stocks, how they continue to hit new highs every single day. At least that's what it seems. But unlike what you're hearing in the financial media every single day, I'm going to explain why you need to protect yourself right now. And then I'm going to break down Tesla, which is reporting after the bell. I'll talk about why Tesla is almost guaranteed to report better than expected results for the quarter. But you'll be surprised how I'm going to tell you how to play it. So let's start with Netflix. Blow out the numbers. Sales rose 13% year over year. Earnings missed by a little bit, but remember, guys, it's not about earnings for the current quarter. It's about your guidance. Okay, you can report shitty earnings, shitty revenue, but if your guidance is much, much stronger than what the consensus is, that little number that they put in the bottom, I'm going to cover that with Tesla, why it's a big deal, then it really doesn't matter, right? It doesn't matter what those earnings are. So earnings came in a little bit light, but their guidance was great. They raised earnings per share guidance by 10%. Next quarter, not for the year, 10%. They also said global streaming net adds with 13.1 million. Okay, I love how Netflix is using net adds as a KPI, okay, key performance indicator. So in your business, you have 4 or 5 that you talk to investors, and those are the ones that are the most important metrics. And they're not all the same. You want to see earnings and sales go higher. For Disney, 3 years ago during COVID, the biggest KPI was subscriber growth, right? Which is pretty big among subscription services, but they were giving it away for free. Sometimes it's same-store sales, which is big for retailers. So it's not always the same KPIs for every company, but net adds is a big deal. Because other streaming companies can't compete with that gauge, with that KPI that they're using. It's kind of similar how AT&T and Verizon does it as well. But nobody in the industry, especially within streaming, are going to be able to report a net add number. Because when you're looking at Disney added 100 million plus subscribers. A lot of those are for free. You're going to see tens of millions of those people drop off, and they're not going to be able to have a net add number. It's going to be a net decline because a lot of these people are coming off the platform. Why Disney Plus? Several reasons. They don't have great new content, which we all know. Their best content comes out in the movies first. I explain this. You're looking at Disney, all these tens of millions are going to come off the file because they were given a platform and given access to free. Right? If you have a Verizon account and you have the family plan, everyone within that family plan was given a free subscription forever. That was me before I switched to AT&T. I no longer have a Disney Plus subscription. But now they're raising prices and they're putting ads all over it. And then, again, you're going to continue to lose people. When you have net ads, right, when you have the net number there, all these platforms can compete with Netflix in terms of the new content, and nobody's canceling Netflix. Okay, people love Netflix. You might say, well, it's a lot of money. I have the full package, which is no ads, 4K, because I have like a theater room, which I love, and I love to watch sports and stuff like that. And it costs me, I think, $25 a month. So whatever, $250, $300. It's going to cost you over $100 to bring a family of 4 to the movies after you buy popcorn for $50 and a soda, right? And for all of them. Oh, I want a soda. I want this. $6, $7, $8, $10 for all this stuff. It's going to cost you well over $100, right? To go to the movies one time, right? So the value that you're getting, constant content, new content, is fantastic, and a lot of these companies are not able to compete. At least a lot of the smaller ones, where the big ones do have the balance sheets to compete. So the net ads is huge, and again, when you're looking at I use Disney as an example, but there's a lot of others there. Time Warner actually just sold because Time Warner, because they're struggling, right? It's a lot of money streaming. We talked about this for 3-4 years. I felt like nobody got it with their model, but they sold Sex and the City, the license rights Sex and the City to Netflix, right? And that's what you're seeing companies doing to try to, leverage some of their assets because they can't really compete with Netflix. And no one's going to pay, especially on Disney, $10, $20 to watch Dumbo 20 times. They want new content. So when it comes to new content, Netflix is king. Now, why does the stock have tons of upside after this? Why would you buy it after the 13% move, which 90% of the time I'd say you're crazy? It's priced in. Here's why. They're the clear winner in streaming in the entire industry. They have a strong balance sheet. They're going to spend $17, $18 billion on new content every single year. Okay, most of the companies can't compete with that. But when you're talking about that, and the companies that compete are maybe Prime and Apple, and Google with YouTube a little bit, but they don't really have too much YouTube TV where they have a lot of new content, right? It's like live TV platform. But when you have that amount of money and things are going that great, what does it mean? Everybody's going to come to your platform. I'm not talking about subscribers. I'm talking about the best writers, the best actors, the best directors. And that's what's happened with Netflix. So this gives them a great runway, or what Warren Buffett likes to call this competitive moat. Always loves to invest in companies with competitive moat, right? That's what he says for the last 40, 50 years. But it gives them this great runway to continue to make great new content going forward. They also have pricing power, one of the few streaming platforms that does today. So the pricing power, and this is the real reason. It's not the 13 million ads. It's not the guidance. This is the reason the stock's up 13% right now. Okay, it would have been up 5% with the net ads. It would have been up maybe 7%, with the raised guidance, 8%. It's up 13% plus. This is the reason why it's up so much. It's the operating margins. Okay, the stock is popping today because it's a stock that has pricing power, and pricing power is massive. Okay, it's much bigger than volume. Okay, so if you have volume, you want to increase volume, you want to increase the amount of subscribers, it costs you money to do that. Marketing expenses, hire more employees, more cut, whatever. When you raise prices, it doesn't cost you a thing. So that's why you saw companies' profits surge when a lot of people, even me, thought they would come down. Because if you have the ability to raise prices, it's massive. If you're charging something that's $20 and maybe inflation pushes it to $22, now you can sell it for $30. That's why you're seeing companies like Chipotle, Lululemon with good products, able to have that pricing power, and their numbers keep going higher and higher. However, we're in a market where inflation is now coming down, and a lot of companies, especially in streaming, don't have pricing power because they're not going to pay a lot, and everyone's paying for one streaming service and maybe another for their live TV. So maybe you have Netflix, maybe you have YouTube TV, Sling, or whatever, and then you're going to limit the other ones. In order to keep the other subscriptions for $10, $15 a month, you want to see new content. But when you're looking at operating margins, this is the reason why the stock popped. Is popping 13% today. It's probably going to end up even higher by the time we close. So when you're looking at those operating margins, they were expected to come in 13.3%. They came in at 17% this quarter, which is freaking insane. There's a reason why you have this in basis points, because if you're able to increase basis points, which is, 13.3 expected to 13.6, that's a big deal. That's great. You're earning more money, profitability, margins are high. That's great. From 13.3% to 17% is unheard of. That's insane. Even crazier is Netflix said next quarter, not next year, not 2025, 27, 29, 30, all these forecasts. In the next quarter, the operating margins are going to be 26%. That's double what was expected for this quarter. So when I see that you have pricing power, when you see the fact that people aren't canceling, they're adding more people, right? There's not a lot of people dropping off the platform where you'll see maybe AT&T or Verizon. AT&T was horrible, by the way, and Verizon was great. I'll cover that tomorrow, Wall Street Unplugged Premium with Daniel, how there's separation between the industries now. You just can't buy any cloud company or any Magnificent Seven. 2024 is going to be the year of a stock picker. All right, not everything in every industry is going to go up. You're going to see separation that happens between management teams, how they manage costs, how they manage through a slower economy. And that's what you're seeing. Netflix, great. Disney, terrible. You're seeing AT&T, terrible. Verizon, great. But a lot of times when they have their net ads, or they'll say, hey, we added 1 million, or say 100,000 new wireless subscribers, they lost 125. So their net ad is actually a negative, or they'll call it, the net loss in terms of ads. It's a very big deal for Netflix. Now, the catalyst ahead for this company, why would I say, wow, it still has a lot of upside? Again, we're up 15% on this in our portfolio for Dollar Stock Club. We bought it 5 trading days ago. That's Wall Street Premium. The catalyst ahead of Netflix, advertising. Advertising is the entire business model for Google and Meta. It's the entire business model for those guys. They make an absolute fortune. It's incredibly high margin if you provide the best tools for advertisers where they can see everything, and also where you're not shoving advertising in your face like when you go on certain websites, Fortune, Street.com, you're going to see 1,000 pop-ups every. It's just as much money as you could possibly make, right? And the experience is terrible, especially they make you click like 3 or 4 pages to go to the story, and it takes like 10 seconds to click through these things, even though you have super high internet 5G. So they're going to come out with a platform that's great where people are not going to leave. It's going to be a great advertising model where it's going to be more targeted for people and showing you ads that you want. This is what happens with Netflix. This is how you use AI when you control the data and you have data for 10, 15 years like this company, like the social media companies, like Google. That's where AI is most effective. That's where it's going to be massive. It's all about data, right? And so you're looking at Netflix with AI and advertising. Advertising is going to be to Netflix what cloud was to Microsoft and Amazon. It's going to change the landscape of the company. It's growing 70% off a very small base year over year. I think from last quarter, and the quarter before that grew 100%. It's going to continue to grow massively. They're going to have people lined up out the door because they know their client. They know it's going to get in front of people. And when you do that, that's why social media, when it comes to advertising, is such a big deal, right? It makes a lot of sense because you're tracking the client. It's more targeted compared to just putting an ad on the Golf Channel when you really don't know someone just left the TV on. If they're watching, who's actually watching it, you don't know. But when you know and you're tracking these people, you know exactly when they're watching, how they're watching something, or in the case of Meta and Google, you're searching for, or where you are, particularly, I'm checking in, which everybody loves to do and tell their life stories. This is going to be massive, and it's just the beginning for advertising. They're also looking into live sports. They just signed a deal with WWE Raw. My wife took me, 51 now, so 50th birthday, she surprised me, took me to WWE Raw live. It was unbelievable, one of the best entertainment things that you'll see. It really is incredible. It's a massive brand. They signed for 10 years, $5 billion. They're also doing, in sports, special tennis, golf, head-to-head matches where they're going to broadcast the biggest names in those sports competing head-to-head, which is, again, you're seeing where Peacock to charge, and this is a couple weeks ago for that, what was it, the Kansas City Chief game, where it wasn't on TV and people were pissed. What did they get, like 30 million people to sign up for it? They were pissed, but they signed up for it. So people are going to pay for great content. Sports is always great content. It's unscripted. It's awesome. But to put Netflix in perspective, sales are projected to grow 15% annually over the next 2 years, much, much faster than the overall market. While earnings, which are expected to grow 12% for the S&P 500, they're going to grow, right now, consensus, by 33% annually over the next 2 years. 3 times faster almost. And I think those numbers are conservative. Now, when you look at Netflix, this is a company that trades at, and look today, $230 billion market cap. I think it was just over 200 before this move. So say $230 billion market cap. Sales are going to $44 billion. That's what's expected for 2024 at $230 billion market cap. Let's compare that to NVIDIA. NVIDIA has a market cap of $1.4 trillion. $1.4 trillion. And you know what their sales? How much they generated in sales in the past 12 months? $45 billion. Netflix is doing $44 billion. I'm not saying that it should have a $1.4 trillion valuation, but it probably should have more like a $500 to $700 billion valuation, which puts it at 3x, 2x, or 3x from here, because they're experiencing this incredible growth where they're taking over the entire streaming industry, and they have this competitive moat that's not going away. So when I look at the Magnificent Seven, which isn't Netflix, right? It's Microsoft, Apple, Tesla, NVIDIA, Google, Amazon, Meta. I think Netflix gets added to this group, call it the Mag 8. People saying AMD should be included. I don't know. Maybe. Or keep it Mag 7 and take out Tesla. I mean, I know that sounds crazy, but Tesla expect to report after the bell today. And they are almost guaranteed to beat this number. And I'm going to tell you why. Guarantee is a word that you should never ever use in finance. They'll come after you. Almost guaranteed. Because the number they have to beat today, which is a consensus, a little number at the bottom, where they're going to say, well, they beat this number, it's 73 cents. Okay, nobody cares like the perspective of that number of where it came from. But if you look at the numbers, it's a difference because while Netflix missed earnings, current earnings by just a little bit, and they raised guidance significantly, their guidance was raised incredibly to show a ton of growth from last year. It just didn't meet the consensus estimates. This is J.P. Morgan's institutional analyst, Goldman, Morgan Stanley, and they have the average of what they're going to earn for the quarter and for the year, and that's a consensus estimate of what those guys say. And sometimes it's conservative, sometimes it's aggressive. Now, at 73 cents, to put in perspective, which you're not going to hear anyplace, if you look at what Tesla generated last year's competitive quarter, this quarter last year, they earned $1.19 a share. So the 73 cents a share is a 40% decline in earnings. Holy shit. Now, ask the question, which is important. How does a company trade at 70 times forward earnings, more than 3 times the 20 times the S&P 500 is trading at? And again, that's what earnings are expected to grow by 12% this year. How does Tesla trade at 70 times forward earnings when they're seeing an earnings decline of 40%? Maybe you say, well, maybe they're investing a lot of money right now. Maybe they just had a down year, whatever. They're lowering prices for all their vehicles. And here I am bitching saying Apple, I think, is crazy. Own Meta, own Google, based on that price to earnings growth, because Apple is not growing earnings and sales, right, for the past 12 months, yet it trades at 30 times forward earnings. And I'm like, wow, that's crazy. If you think that's crazy, I mean, that's a steal compared to Tesla. Again, this is a company that's lowering prices for its cars, for its EVs. So I think they easily beat the 73 cents number, maybe report 90 cents plus. They better, because if they report lower than 73, you're going to see the stock get hammered. I mean, must better have a good earnings call and talk about, delivery on Cybertrucks, which everybody wants to hear. Raise unit sales. Again, those record sales are a big deal. They like to hear that record sales, even though margins are coming down. Talk about tax credits, which recently in January, a lot of those are no longer available for certain models, including the Cybertruck, believe it or not. That just passed. We have seen costs come down for nickel, cobalt, stuff like that, but they keep lowering prices. You priced everyone in America out of the market, but China is still their biggest competitor. And they're trying to compete by lowering prices. So looking into the quarter, the stock has taken a nosedive. And you may say, okay, well, a lot of this is priced in. But remember, it's still really, really expensive given that earnings have crashed as well. So when I said, when I liked NVIDIA, and I missed it on the way up, when I saw it at $300 a share, I'm like, wow, it shouldn't even be. It was like $280. I'm like, this is crazy. There's no way they can meet the number. And they had the greatest quarter I think I've ever seen since I've been doing this for 3 decades. I mean, unbelievable, right? I mean, expected $7 billion, did like $14 billion or whatever they did, 10.5, and then they did 14 following. So as that stock is going up, it's actually trading cheaper because their earnings are surging. This is totally different with Tesla. Their earnings are crashing, and now the stock price is coming down. So they better report something great. I think they easily beat this number. Maybe it goes up on it, and people are going to say, wow, they blew out the numbers. They're reporting record sales. Be careful, because these guys are lowering estimates. Those tax credits are not available. I think it's for the Model 3 and the Cybertruck, but be careful, because if this stock pops, and it should, because they have to beat that number. If they don't beat that number today, I'm going to be very surprised. They have to beat that number. But they're going to beat that number. And when they do, this stock is probably going to rise. And when it does, I would be very, very careful if you're owning Tesla. I would take some off the table until they figure this shit out. It's a great company. If you doubted Elon Musk, you lost every time. I've had people that are hired that short Tesla. They short at Tesla, split adjusted probably in the 30s and 40s and 50s. Let's go to 200, even 300. But you're going to need a lot of magic. Eventually, it's about the numbers. That's what I always said about Disney. Eventually, you could add 500 million subscribers, but if they're paying nothing and your margins are terrible, your average revenue per user is $4 compared to 17, 18 for Netflix, those numbers are going to matter sooner or later. They're going to matter sooner or later. And now they're mattering for Disney. That's why Nelson Peltz had a horrible year because of the position he has in Disney. So those numbers are going to matter. They really didn't matter because you saw the growth. And people are going to pay for growth. Like, it doesn't matter. Tesla's growing. Look how many cars they're producing. They're great. Those numbers, the earnings, the balance sheet, all that shit, all those risks, right? Now they got a good balance sheet, generating tons of revenue. Now it's not like that anymore. If you're lowering prices for your vehicles, you better see huge growth in unit sales, and you better have a great call today, even though you're going to beat those numbers. Otherwise, you're going to see the stock pop and probably over the next week or two start falling because short positions are building. It's only 3% of the float, which is much bigger than most companies that size. Usually it's 1%, 1.5%, probably lower than 1%. You're going to see it build probably to 5%, and they're going to have a good case. It's okay to trade at a premium valuation, but you have to be growing your earnings and growing your company. So let's see how the market's going to look where, okay, we're expected to produce, record unit sales, which is, again, they're going to announce that. Let's see how the market takes that because they keep lowering these prices where the margins are getting crushed, and you don't see many companies trading at 70 times forward earnings when the earnings are declining 40% year over year. That's pretty crazy. Now, let's talk about the markets real quick before I go. You really don't need me. I don't know why you listen to this for. Just buy stocks. They go up every single day. Nobody gives a shit. It goes up. Doesn't matter what you looked at, what you learned, what you studied. Throw out every textbook. Doesn't make sense. Doesn't make sense. We traded 20 times forward earnings. We're trading at record levels. The market is higher today than it was before the Fed started raising interest rates. So interest rates was 0 2 years ago. Relatively 0. A little bit above that. 5.3%. And everything's fine. And I watch CNBC because that's a consensus, and I'll switch to Bloomberg and Fox Business just to see what they're saying. And everyone on these channels, most people are super bullish, and it makes sense if you're a trader. You broke through these readings, and you never want to really sell stocks when they hit all-time highs. I get it. I understand from technical levels. And then you have them, when they ask them, what do you think the market's going for? They have the standard, well, we could see a pullback, but we're going to probably end higher at the end of the year. I mean, which is like Bill Belichick saying, we're either going to win this game or we're going to lose this game, which is completely fucking useless. And I love that. They cover themselves. I told you the market was good. If it falls 20%, I told you we could have fell 20%. Remember I said that. But yet you have optimistic targets for the end of the year, which everybody has. 5,000, just incredible. I'm going to tell you something about this market. It's a rare animal. It's something none of us have seen before. And when I'm hearing economists look at unemployment and inflation coming down, and wage growth pretty solid, and they're looking at, interest rates are going to fall in 2024. A lot of these economists are like, hey, the economy's strong. I keep hearing the economy's freaking strong. Are you crazy? And the housing market is frozen. I'm not talking about for new builds and people buying these new homes right now, but if you want to sell your house right now, good luck. I'm in Florida. My house is on the market for 5 months. I got one offer, and I lowered it by 15%. People are going from under 4% mortgages to well over 6%, maybe, a little bit below that pretty soon. But the housing market with interest rates, and that's a major driver of economic growth. So how are we going higher? Well, look at the government spending. We spend trillions and trillions and trillions of dollars on all these plans. That's what happens. Look at U.S. bank credit. If you're looking at credit for U.S. banks, it's only been negative year over year one time since 1974. One time. That was during the credit crisis when the entire financial system almost collapsed. The Fed didn't bail us out. No financial system. We'd have 30, 40% unemployment right now if that happened. Believe me, all the banks closed. You wouldn't be able to get your money. Riots in the street, right? That's when we saw that. Like negative, when bank credit turned into the negative. Showed these charts on Wall Street Unplugged Premium last week. And guess what? Right now we're negative when it comes to bank credit. You can see the chart the whole time since 1974. It's only fell below the negative level one time. That was during the credit crisis. We're negative now. Stocks are at all-time highs. At all-time highs? Maybe with 10% off the highs, 5% off the all-time highs? Leading economic indicators. That's the biggest gauge. It's the best gauge ever. Everybody uses it. Why? Because it's a perfect economic indicator that predicted every single recession. So when this turns negative, and you go back to data of 1970, 100% of the time we saw a recession. The leading economic indicators, the LEI, has declined. They just came out there 2 days ago for 21 straight freaking months. Does this sound like a market where the economy is strong and stocks are trading all-time highs? We all hear about the yield curve. When it goes negative, it's a sign a recession is coming. But when you really look at the data and dig in, it's not that the yield curve is the indication. But the recession usually takes place several months after when the curve turns back positive. You're not used to it because we're not used to seeing a negative yield curve. So inflation went through the roof and all this craziness and interest rates are rising. So when you're looking at the data, you compare it to history, it's not like Yeah. Oh, negative yield curve. We're going to have a recession tomorrow. No, it's when we come out of that and it turns positive a few months later. That's when we have the recession, when the curve is no longer negative. So be careful for people saying, wow, it's no longer negative. That's a positive thing. Another thing that everyone says is positive is interest rates. Interest rates are coming down. How many times have I heard that catalyst and interest rates still haven't come down? Like the Fed hasn't cut. We've heard that. 2023, if you look, I'm telling you, I would say 100%. I hate using absolute terms. But if you look at anyone who predicted a bull market last year and said the market's going higher, almost 100% of the people, I haven't seen anyone say interest rates are not going lower and the market's going high. Every one of them said interest rates are going to come down tremendously. Inflation's coming down. That's their thesis. That was their thesis for the bull market last year, and we still haven't seen rate cuts. And we might not see them to May now. Remember, it was March, and the Fed came out in December. It might happen in January. Who knows? You're going to pivot, and they walk back their pivot for some reason, which is weird. But we've seen, if you look at the data, we've seen the biggest stock market pullbacks, not when the Fed starts raising rates, which people think because it gets tighter, but it makes sense because if the Fed's raising rates, it's because it's a sign the economy is doing great and we need to slow it down. But the major pullbacks occur when the Fed starts to cut rates. And everyone's saying that's going to be the catalyst. Is it really? Because if you look back at history, be careful. Careful what you wish for. Because even now, even today, analysts coming on TV saying, hey, we have a 5,000 target on S&P and the market's going to go up 10% this year and because we're going to see a massive decline in rates and the Fed's going to cut. I mean, newsflash. The market's already pricing this shit in. We know we're pricing in. We were pricing in 6 rate cuts this year. It might be 4. We're pricing that in. And they're like, well, that's the catalyst. Someone's been doing this for a very long time. If you're talking about something and everybody's talking about it, it's factored into stocks. It's what are people not talking about? That's when you get the black swan events. Like we've seen with commercial banking last year. Like we've seen, just with interest rates in 2008, 9, right? I mean, we saw the black swan events. Holy shit, man, how much exposure? Like nobody knew how much exposure all these assholes in the banks had to the housing market and how much they leveraged themselves when the regulators were asleep at the wheel. We all know that the Fed's going to cut. That's your catalyst. But when these cuts happen, it's an indication. Why do they cut? It's an indication that the Fed expects the economy to slow. And they're going to expect it to slow sharply. I mean, when you look at GDP, we're calling for GDP, what was it, 5% last? I mean, with GDP for all 2024, economists have it just over 1%. Some have it 1.3, 1.4. That's a massive slowdown. Does that make sense to you? So stocks be trading at all-time highs, valuations super expensive, but economic growth is projected so dramatically over the next 12 months. It's not just the U.S. That's all over the world. Outside of some bright spots like India. Be careful here, guys. I'm not telling you to pull everything out of the market. Absolutely not. But in tomorrow's Wall Street Unplugged Premium Podcast, Dan and I are going to show you how to hedge your portfolio. I know hedge is a boring freaking word, but trust me, it is really, really, really important for your livelihood, for your family, for your assets to understand. Okay, what industry experts call it, we call it, is risk adjusted. So if you are, for example, last year, thought the market was going to crash in the first half, right? We came down, fell a little bit more in 2022, and then it went back up. I was wrong that their earnings weren't going to meet their estimates. Our portfolios did fantastic. We didn't do as good as the Big 7 or the NASDAQ going up 40%, but we did very, very well, but we had risk adjustment strategies on it. We said, okay, buy puts. Be smart. That's fine. I'm okay. Still did well, still did great. I didn't say, all right, short the market, you're crazy, get out of the whole entire market. No. I'm talking about hedging your portfolio in case. Because that in case, the case for in case is getting bigger and bigger and bigger and bigger. Because the things I'm seeing, you normally don't see in a market when you have stocks at all-time highs. You don't see bank credit shrinking. You don't see leading economic indicators horrible. You don't see the money supply absolutely crashing. These are not associated. You don't see negative yield curve, right? These aren't associated with a screaming bull market, stocks at all-time highs. So be careful. Could it go higher? Of course. I'm not going to tell you to sell stocks when they're all-time highs. The strategy that's going to punch you in the face. I've learned that. But be careful. Be careful. There's a reason why the Fed walked back their comments and they told all the Fed presidents there too, which they always speak their mind. You know that there was a meeting that was taking place after Powell and everyone said he pivoted, that they walk back those comments. And those guys usually say what they want to say, but they all kind of walk back. I don't know, maybe interest rates, we're not lower them yet. Why? So tomorrow's Wall Street Unplugged Premium Podcast is going to break down several of those strategies to protect yourself and also share our newest recommendation, which I think you should pay close attention to. Doing pretty good in that newsletter. Early on, uranium, right? Well, uranium prices, what's uranium prices? Over $105 now? Holy cow. I feel like yesterday with 35. $40. Benefited a lot from those stocks. And then Netflix. Understanding that story going in, even though it was running up a little bit. But being up 15% of the stock in 4 trading days is probably enough to pay the $10 a month subscription to Wall Street Unplugged Premium per month for the next 3 to 5 years. That's what that premium product is about. Having access to that Dollar Stock Club portfolio, which is a trading newsletter, which some people charge $1,000 a year for that, and you get all that access. So if you're interested in learning more about Wall Street Unplugged Premium, and you're new, okay, if you're new, just go to WSUpremium.com, and you're able to try it for $1 for the first month. That's it. If you want it, you want it. If you don't, cancel. That's fine. I tell you, we don't have a lot of cancellations because the value you're getting from that and stock picks and trading is really, really cool, and that's what we want to do with this business. We want to create that type of investment club where we're sharing ideas. I don't have to hold back from different things where people are paying for it, but they're paying for a service that has tremendous value. That's why we created the Wall Street Unplugged Premium brand, and I love having Daniel on it. Again, going to break down those hedging strategies, how to protect yourself, not to sell stocks, but how to protect yourself, and also we'll have our new recommendation. So guys, that's it for me. Questions, comments, for the email frank@curzioresearch.com. I'll see you guys tomorrow. Take care. Love this episode of Wall Street Unplugged? I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. Well, I'll do even more than tell you what's moving these markets. I'll tell you specifically what moves you can make today. So this is going to be about trading. Put big money in your pocket right away due to the inconsistencies I see daily in the market. I'm talking about specific investment ideas I'm recommending and tracking each week that I believe will be impacted directly by everything I just talked about today. Plus, you're going to get the chance to go even further down the rabbit hole with me and my co-host, who's Daniel Creech, as we discuss which of these week's trends could turn into massive windfalls. The big trends that we see lurking on the horizon, also the news we're picking up from our network of insiders, which has gotten bigger and bigger thanks to you and so many people listening to this podcast in over 100 countries. And you get a chance to talk to me directly in my special Ask Me Anything Q&A session. All of that and a lot more, like premium interviews with world leaders in finance, technology, industry, and politics. This is all part of Wall Street Unplugged Premium. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today, and you won't miss a thing. That's WSUoffer.com.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.